First, let me thank Senator Dodd for bringing forward a strong bill to regulate Wall Street. The bill provides for strict new regulations to stop Wall Street's reckless gambling. And I think one needs to understand the current system and how we got to where we are today. We have 8 federal regulatory entities that oversee the financial sector. Now, their authority is different, their powers are different, their ability to respond to a particular problem is different, and the entity that's regulated today can shop for the regulator that they want by what they call themselves and the type of activities that they try to define themselves as. They can shop and look for the regulatory entity that they believe they can circumvent the easiest. They can escape and did escape proper supervision. Well, this legislation ends that practice by a clear regulatory framework in order to regulate all financial institutions. The regulatory entity that does the regulation is based upon size and jurisdiction, and we have a Financial Stability Oversight Board that provides uniformity. No more gaps in the regulatory system, and it provides the tools for the regulators for early intervention. That means we end, once and for all, too big to fail. By early intervention on takeovers, closing down financial institutions, requiring the sale of financial institutions, we can prevent the need for too big to fail. The risk will be on the investors, not on the taxpayers of this country. The Boxer Amendment makes that clear. Tools that are needed for orderly liquidation to minimize the impact on the financial sector and our economy is provided in this legislation. It recognizes the need for special attention for our community financial institutions. Madam President, they were not the cause of the financial crisis that we went through. We know it came from Wall Street. Our community banks were very much vulnerable as a result of the financial collapse. We need to streamline the regulatory process as it relates to our community banks. Regulation is cost. We have to have regulation. We need regulation. They need regulation. But we need to make sure it's sensible. This legislation puts the consumer first, as it should, with a strong consumer bureau. Now, some say, why do we need that? Isn't the current adequate regulation? The answer is no. All you need to look to is what happened in the residential mortgage marketplace. All you need to look at is the advertisements that were taking place just 2 years ago for no docs or stated income loans or no down payment loans, loans that provided over 100% of the cost, and look at the subprime lending in each of our communities, where home buyers who could have qualified for traditional home mortgages were steered into the subprime market because the mortgage company or the seller made more money by steering into subprime. Well, those practices have to come to an end. Those practices sparked, as we know, the housing sparked the trigger for this recession. These practices helped create that bubble that burst. And what damage did it cause when it did burst? I mean, when we take a look at the cost of this recession, the Pew Financial Reform Project has estimated that just a slowdown in the economic growth will cost every family in America close to $6,000. Well, that's money that will never be made up. We have to make sure it never happens again.